interest rates, years of easy money, as the chairman was highlighting, and stimulus-fueled consumer spending, this administration and the Fed overheated our economy and then were late to pump the brakes. Or to borrow that punch bowl analogy from Alan Greenspan, no one had the courage to take the punch bowl away from the party. So I'm sure some of my colleagues are ready to let you off the hook and maybe try to change the narrative. It should not be understated that the management of each of your banks is questionable at best. You were inept at managing both short and long-term risks. You courted deposits from risky businesses, took untenable financial risks, and ultimately failed to respond to rising interest rates. And Mr. Becker, your relationship with the San Francisco Fed should be scrutinized. At the time of its failure, SVB had 31 open supervisory failures or warnings from regulators, and yet nothing was done. It was not gone unnoticed that your position on the Fed's board of directors potentially created a relationship that impeded supervisors' judgment and created some of that leniency. And for their part, the Federal Reserve missed or ignored all of the signs, and when they did react, it was too late. Yesterday, in testimony before our committee, the Vice Chairman of Supervision, Mr. Barr, the other Mr. Barr, at the Federal Reserve, admitted that what we have all known for months. The failure of your banks was a result of failed supervision under his watch. He finally admitted that he had the responsibility of that. However, federal regulators will attempt to use these bank failures to exercise more and more authority well outside the bounds that Congress established for them, and the notion that these failures were a result of regulatory changes is unfounded. As we heard from the GAO, their reports about the Fed started in 1991, not 2155. It was 1991. Nevertheless, regulators will try to shift the blame, but the facts are clear. And in testimony before our O&I subcommittee last week, the GAO flagged those concerns in supervision and enforcement practice going back to 1991. The report concludes that all three federal financial regulators have, quote, wide discretion in choosing from among enforcement actions of varying severity, close quote. Lastly, an independent assessment of these events is not only appropriate, but it's desperately needed. This committee is committed to providing the American taxpayer with an unfiltered review of the events that preceded these bank collapses, and ultimately, they bear the cost of your failures. I look forward to hearing from each of you as we continue to seek these answers, and Mr. Chairman, I yield back the balance of my time.
The gentleman yields back. I now recognize the gentleman from Texas, ranking member of the Oversight and Investigation Subcommittee, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Mr. Chairman, holding this oversight hearing today with the former chief executives of Silicon Valley Bank and Signature Bank will allow important questions to be asked and answers to be received from those who nurtured the root cause of their bank's collapse. At yesterday's hearing, regulators acknowledged their shortcomings. Today's preeminent question is, will today's bankers acknowledge their faults? Will they take responsibility for the more than 70% uninsured deposits that alarmed depositors? Will they acknowledge both Silicon Valley Bank and Signature Bank experienced outsized growth between 2018 and 2022, and that Signature Bank grew from approximately $47 billion in total assets in 2018 to $110 billion in 2022? That Silicon Valley Bank increased from $56 billion to $209 billion over that same period of time? Will they admit that this outsized growth in assets was fueled by more than 70% uninsured deposits at both banks, far higher than the median of 32% for comparable banks? Will they confess that the executives at both banks knew or should have known that their risk management practices had to be strengthened appropriately as they grew in size exponentially? Will they concede that it was irresponsible for Silicon Valley Bank to operate without a chief risk officer from April until December 2022? Will they agree that those who nurtured the root cause of a bank's collapse should return any bonuses received as the collapse came to fruition? Will they allow and avow that upon Silicon Valley Bank having received 13 of the most serious supervisory warnings the Fed can issue, the bank's officers should have taken corrective action? And will they come clean about Signature Bank's failure to take corrective action after having received 9 matters requiring board attention notices from the Federal Deposit Insurance Corporation, including 3 specifically related to liquidity or risk management? Mr. Chairman, the time for atonement and recompense is at hand. Today provides us the opportunity to hear from those who had a hands-on experience with the failure of these banks. These persons were capable, competent, and qualified. They all have degrees indicating such, and they have experience connoting such. They should have taken corrective action. They will be given the opportunity to answer these questions that I've called to the attention of not only this committee, but also of this country. The people of America need to know what happened at these banks. This is the time for us to find out. I yield back the balance of my time.
The gentleman yields back. I now recognize the gentleman from North Carolina, the chairman of the full Committee on Financial Services, Mr. McHenry, for 2 minutes.
I want to thank Chairman Barr and Chairman Huizinga and the ranking members as well. At today's hearing, we'll hear 3 different stories from 3 different banks. Your business models were not the same. Your depositors were not the same. The degree of mismanagement was not the same in the midst of this crisis. The truth is, each of you bears responsibility as the captain of your respective ships. And we've heard that from you. There was a storm brewing, and you failed to batten down the hatches. And while inflation raged, the Fed and the Biden administration told us it was transitory, nothing to worry about. We'll get into the management question shortly, but one of the mistakes, though, is that these 3 bankers actually believed the bureaucrats. We all know inflation was not transitory, and after being late to respond, the Fed was forced to raise rates at the fastest pace in modern history. And again, you failed to appropriately prepare for this inflationary and high interest rate environment. Silicon Valley Bank was the projectile that set this volatility into motion. The Biden administration used another word to describe SVB, idiosyncratic. Well, clearly, as there are 3 of you today, 3 of the 30 largest banks in American history, in America today, the problem goes much deeper. The subsequent failures of Signature and First Republic, coupled with the volatility in regional bank stocks, sent shockwaves through our financial system. The fear of contagion has rocked an already shaky economy. So we'll hear from each of you today and the New York and California bank regulators as well. I think it's important to take a step back and really examine the undercurrents that caused this crisis. The economic mismanagement by the Biden administration that created the perfect storm that each of you failed to right your ship in. I yield back.
The gentleman yields back. Today we welcome the testimony of Mr. Greg Becker, former CEO of Silicon Valley Bank, Mr. Scott Shea, co-founder and former chairman of Signature Bank, and Mr. Michael Roffler, former CEO and president, First Republic Bank. We thank each of you for taking the time to be here. You will each be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, each of your written statements will be made part of the record. Mr. Becker, you are now recognized for 5 minutes.
Chairs Barr and Huizinga, ranking members Foster and Green, and members of the subcommittee. Thank you for the opportunity to appear before you today. My name is Greg Becker, and I was the CEO of Silicon Valley Bank. I'm here today to answer your questions about what happened at SVB to the best of my memory. At the outset, I want to be clear that I never envisioned myself or SVB being in this situation. I was an employee for SVB for nearly 30 years and CEO for the last 12 years until it was taken over by the FDIC. I believed in the bank and its mission and cared deeply about our more than 8,000 employees and their families. I was committed to our clients and helping them succeed, whether they were well-known tech companies or small business founders in towns across the country. SVB was designed to meet the needs of the technology and life science industries where startups and later stage companies could keep their deposits, borrow to expand their businesses, and create jobs. We knew our clients personally, understood their needs and goals, and partnered with them as they grew. We took risk management seriously and worked closely with and were responsive to the various regulators who oversaw SVB. Over time, we built and expanded a team of subject matter experts focused on analyzing risk and protecting the bank, and continually sought to add operational expertise and experience to enhance our risk management as the bank and its clients evolved. Much has been said about the takeover of SVB by the FDIC and why it happened. Ultimately, I believe that SVB's failure was brought about by a series of unprecedented events. Between 2015 and 2019, SVB grew from about $45 billion in assets to $71 billion in assets at an annual rate of about 10%. This changed in 2020 due to the COVID-19 pandemic and the government stimulus measures. With near zero interest rates and the largest government-sponsored economic stimulus in history, more than $5 trillion flooded into commercial banks in the United States. By the end of 2020, SVB had grown 63% over the prior year, and in 2021, SVB's assets grew another 83% to $212 billion. To support this growth, SVB raised more than $8 billion of new capital in 2021. Importantly, throughout 2020 until late 2021, the messaging from the Federal Reserve was that interest rates would remain low and that the inflation that was starting to bubble up would only be transitory. During this time, SVB invested in low-risk, highly rated government-backed securities. These securities were safe assets, and they were backed by the U.S. government and could easily be used as collateral for borrowing for liquidity if we needed it. These fixed-income securities complemented our short-duration loan portfolio, approximately 90% of which had variable interest. Actively invested nearly $2.3 trillion of their securities portfolios in this low-yield environment created by the Federal Reserve. To account for changing market conditions, namely higher interest rates anticipated over a longer period of time, on March 8th, we sold SVB's available-for-sale securities portfolio in a planned capital raise. Unexpectedly, on this same day, Silvergate Bank announced its intent to voluntarily wind down and liquidate, and depositors triggered a run on that bank. Despite stark differences in our business models, news reports and investors wrongly lumped SVB and Silvergate together. Rumors and misconceptions quickly spread online, culminating on March 9th with the first ever social media-driven bank run, leading to $42 billion in deposits being withdrawn from SVB in 10 hours, or roughly $1 million every second. Over 2 days, approximately 80% of total deposits were requested to be removed from SVB. To put the unprecedented velocity of this bank run in context, the previous largest bank run in U.S. history was $19 billion over 16 days. In the face of these unprecedented events, the leadership team and I made the best decisions we could with the facts and forecasts available to us at the time, and in the best interest of SVB, its employees, and its clients. I worked at a place I truly loved, alongside our dedicated employees to support our clients who are innovating in astonishing ways. I believe that SVB had a positive impact on the roughly 100,000 clients.
The gentleman's time has expired. Mr. Shea, you are now recognized for 5 minutes.
Chairman Barr, Chairman Huizinga, Ranking Member Foster, Ranking Member Green, and members of the subcommittees. Thank you for the opportunity to be here today to discuss Signature Bank and my role as chairman of the board. In 2000, I co-founded Signature Bank. At the time, the banking industry was experiencing many mergers, and many big banks were not serving the needs of middle-market customers. I felt that a mid-sized bank would provide an important commercial services to businesses that preferred a smaller, more personal experience. Signature Bank followed a single point of contact approach in which the bank's client teams personally served the needs of small and medium-sized businesses. Our bank had a diverse group of clients, including industrial companies, commercial real estate firms, healthcare providers, professional service firms, nonprofits, and many others. We placed a priority on providing financing to affordable housing providers in low and moderate income areas, and did so for many years. Through the hard work and dedication of our employees, we went from a small bank with $40 million of startup funds to a successful middle market bank with more than $100 billion in deposits. We were a solid and thriving bank that played an enormous and important role in our clients' businesses, and I was very proud of our success. In 2018, we began accepting deposits from businesses in the digital asset sector. I supported this effort because I believe that digital asset payment systems can make financial transactions faster, easier, and cheaper, with funds moving from place to place in minutes rather than hours or days, and at a much lower cost than traditional payment systems. I was not alone in my enthusiasm for digital assets. Over the years, many other banks, many financial institutions, and others have entered the market for digital assets, and governments, both state and federal, have expressed support as well. As with other parts of Signature Bank's business, digital deposits grew over time. Nonetheless, because this was a relatively new sector, Signature Bank carefully monitored the business in an effort to ensure that clients met our internal standards, including for compliance with anti-money laundering laws. We also limited the kinds of businesses that we would do. Signature Bank's digital asset business was focused on accepting U.S. dollar deposits from businesses in this sector. Additionally, I publicly supported increased government regulation of the digital asset sector in order to ensure that businesses operating within the sector had regulatory oversight. In the latter part of 2022, the digital asset sector experienced increased volatility and regulators expressed concern. Signature Bank took these developments seriously and in just a few months significantly reduced its digital asset deposits. Unfortunately, a series of truly extraordinary and unprecedented events unfolded quickly. On March 7th, the bank with strong ties to the digital asset sector announced it was going out of business, and 3 days later, on March 2nd, a second bank was closed by the regulators. And then, within just a few hours, our depositors withdrew $16 billion from the bank. Nonetheless, I was confident that Signature Bank could withstand the economic earthquake that occurred that day. The bank was well capitalized. The bank was solvent. Indeed, it was always solvent, with assets well in excess of liabilities even at the very end. And the bank had a well-defined and solid plan to continue in operation and withstand additional withdrawals. Although I believed that the bank was in a strong position to weather the storm, regulators evidently saw things differently. On Sunday, March 12th, regulators seized Signature Bank. Although I disagreed with this decision, I recognize the important role the bank regulators play in our financial system. My first priority in helping to build Signature Bank was providing excellent service to our customers. I was therefore pleased that the government guaranteed the full amount of customers' deposits. Helping build a bank that for 22 years played an important role in the middle market sector of our economy was the pinnacle of my professional life. For that reason, March 12, 2023 was a devastating day for me.
Gentleman yields back. Mr. Roffler, you are now recognized for 5 minutes.
Thank you. Chairman McHenry, Ranking Member Waters, Chairman Barr, Chairman Huizenga, Ranking Member Foster, Ranking Member Green, and members of the subcommittees. Good morning, and thank you for allowing me to speak with you today. Since 2009, I have had the privilege of serving First Republic Bank and its employees, clients, and communities. I look forward to sharing with you a little about First Republic, our reputation for risk management and integrity, as well as our understanding of the unprecedented banking crisis that affected us beginning on March 10th. I would like to start by thanking my incredible colleagues who have worked tirelessly since March 10th, continuing to serve our clients and delivering outstanding service in the face of unprecedented challenges. For the past 37 years, First Republic has built a reputation for its commitment to extraordinary client service, careful risk management, robust internal controls, and transparency with our regulators and the public. First Republic's financial position and strategy were regularly reviewed by our regulators, the California DFPI and the FDIC. First Republic's management and board of directors took regulatory feedback extremely seriously and addressed any matters in a timely manner. Neither regulator expressed concern regarding First Republic's strategy, liquidity, or management performance, just the opposite. Up until the cataclysmic events of March 10th and the following days, which were triggered by the collapses of Silicon Valley Bank and Signature Bank, First Republic was in a strong financial position with strong investment-grade ratings aligned with the nation's largest banks. In fact, thanks to our employees' extraordinary efforts, First Republic had its most profitable year ever in 2022. Starting in the fall of 2022, First Republic believed that the Federal Reserve's campaign to fight inflation by repeatedly and significantly raising interest rates would make 2023 a more challenging year from an earnings perspective. First Republic was transparent about the challenges posed by this higher interest rate environment. No one at First Republic could have predicted the collapse of Silicon Valley and Signature, the speed at which it happened, or the impact it had on the banking industry. Instead of dealing with temporary decreased earnings due to interest rate pressures, First Republic was contaminated overnight by the contagion that spread from the unprecedented failures of those banks. Before March 10th, First Republic was conducting business as usual. Indeed, during the day on March 9th, as uncertainty surrounding Silicon Valley grew, we experienced a significant inflow of deposits at First Republic from clients who had withdrawn their money from Silicon Valley. Everything changed overnight. On the morning of March 10th, when Silicon Valley collapsed, a run on First Republic began. In response to an industry-wide pandemic about the soundness of regional banks, industry-wide panic about the soundness of regional banks, which was exacerbated by traditional media and social media, over the course of the ensuing weeks, over $100 billion in deposits were withdrawn from the bank. Despite Herculean efforts by my incredible colleagues at First Republic to continue providing exceptional client service, management's tireless efforts to save the bank, and the support of 11 of the nation's largest banks, investor and depositor confidence never recovered. Throughout this period, I encouraged colleagues to be there for and to serve the needs of our clients. But clients continued to withdraw their funds, and to protect our clients and depositors, the FDIC reached a purchase and assumption agreement with JPMorgan Chase to assume all of the deposits and substantially all of the assets of First Republic. We continue to work hard every day to ensure our clients receive the service they deserve. I look forward to working with the committee to restore confidence in the banking industry, and I would be pleased to answer your questions.
I thank the witnesses for their testimony. We'll now turn to member questions, and I'll recognize myself for 5 minutes. Let me start by following up on a line of questioning that I asked Vice Chairman Barr yesterday. And I asked Mr. Barr if the delay in monetary policy normalization in light of persistent and high inflation, I asked him if gradually tightening monetary policy versus precipitously raising rates would have made it easier for the Fed to supervise and banks to manage interest rate risks. He declined to acknowledge that monetary policy failures by the Fed were the underlying cause of the current instability in the system. While I do agree that it is the responsibility of bank management to manage interest rate risks, I believe we should also acknowledge that the Fed's unprecedented and protracted easy money policies, quantitative easing, and keeping interest rates too low for too long, necessitated an historically rapid and precipitous increase in interest rates, 500 basis points in just 13 months, leading to a blunt and difficult interest rate environment for institutions to adjust to. Mr. Becker, did bank supervisors at the Federal Reserve of San Francisco show any extra attention to interest rate risk issues? And if they did, when did they begin to show that attention?
Chairman Barr, to my memory, the rapid rise in interest rates were going back to 21, that topic coming up. I don't remember that coming up to the best of my recollection.
So you're telling me that as the San Francisco Fed, 20 bank examiners in your bank every day, not once in the last year do you remember any of those bank examiners discussing interest rate sensitivity with you?
With me, my memory is no. It could have happened with our Treasury team or our CFO, but I don't remember having a direct conversation about that.
Mr. Becker, Silicon Valley Bank did not have a chief risk officer 8 months leading up to its failure. Clearly, there were major interest rate risks that obviously were not being discussed by the bank regulators with you all. But it's safe to say that a chief risk officer would have been a useful addition to the management team. What were your conversations with the Fed on this issue, and did they voice any concerns with the vacancy or request that you take action to fill the position, and if so, how did you respond?
Chairman, as I outlined in my written testimony, towards the end of 21 and the beginning of 22, our board of directors and the regulators, the Federal Reserve, were giving us comments about the need to enhance our chief risk officer position, especially as we started to approach $250 billion of assets. We took that feedback very strongly, and we decided to make a change. So we did two things, knowing that it takes, quite honestly, a while to find the best candidate for a role. In my assessment, it takes 6 to 9 months to find an executive of the caliber that you would want. We did two things to make sure we didn't have gaps during that period of time, of which both of those things were noticed and, before we made the change, communicated to the Federal Reserve. First, we created an office of the Chief Risk Officer. It was a leadership team of the risk team, along with new hires with LFI experience. Those individuals reported to me, and they also reported to the chair of our risk committee. The second thing we did, we kept our existing Chief Risk Officer on board as a consultant from April until October 1. Our new Chief Risk Officer started or was hired October, and then she started in December.
Did the Fed express any concern that, despite standing up an office, that there was not a position filled?
They did not.
Okay, Mr. Roffler, it's our understanding that prior to entering receivership, you had viewed all options on the table, including the sale of your bank. Can you describe the difficulties you faced in finding a potential acquirer? If you could turn on your mic.
My apology. Thank you, Mr. Chairman. Yes, following the events of March 12th and 10th and shortly thereafter, we worked with our legal counsel and our independent advisors to look at all options on the table, including potential merger, potential sales of assets.
Did the FDIC begin to gather and distribute data about your bank to potential acquirers prior to the week of April 24th?
Not to my knowledge.
Mr. Becker, FDIC Vice Chairman Travis Hill recently stated that the FDIC could have moved more quickly in finding a buyer for Silicon Valley Bank, saving the hit to the diff, if they had shown some more urgency in setting up data rooms. Can you explain your perspective on how this process worked and whether the FDIC could have done better?
So again, this happened very fast, and so on March 9th, which is really the first day that the bank run started, the FDIC got involved, and then they took over on the 10th. We immediately worked with them and worked as fast as we could to build a data room with the list of information they were looking for.
My time has expired. Obviously, it was not fast enough. I now recognize the ranking member of the Subcommittee on Financial Institutions and Monetary Policy, Mr. Foster, for 5 minutes.
Thank you, Mr. Chair. Mr. Becker, I accept what you said, that you never envisaged the situation that Silicon Valley Bank had come into. But my focus here is what rules could have been in place that would have changed your behavior. I imagine you spent a lot of the last few weeks thinking about what you should have done if you had perfect knowledge ahead of time. And high on my list are simply hedging your interest rate risk instead of apparently removing some interest rate hedges, and also raising capital last summer when you still could. Are there other major things that you wish you had the foresight to have done?
Congressman, maybe just to comment on your one point about capital raising. Our capital ratios, even up until March 10th, were actually very strong.
I understand, but one of the rules changes we can contemplate is to make you immediately recognize some fraction of your mark-to-market losses on securities. All right, and so one of my follow-on questions here, which you can try answering now, let's say that you had immediately had to recognize 100% of your actual mark-to-market losses. Would that have affected your behavior materially?
Congressman, the mark-to-market is in two categories. One is your available-for-sale portfolio, and then your held-to-maturity.
Right, just say all of it, just to take an extreme case, all of it.
Yes, if everything, both available for sale and held-to-maturity, was mark-to-market, yes, we would have had to raise more capital.
Yeah, and it would have happened early, last summer probably, when interest rates started going up.
Yes,
And that would have,
when the mark-to-market occurred, correct.
yeah, and in all probability, you would be solvent today if that had been the rule. Now, there are many, I'm not saying that should be the rule, but there's a knob that we can adjust, which is what fraction of the mark-to-market losses should be immediately reflected.
Congressman, as I mentioned in my testimony, I believe this was unprecedented events. At the end, it was fueled by the fastest bank run in history, and I don't believe, my opinion, even with additional capital, if that were to occur, I don't think we could, or possibly any bank could, have lived with that amount of deposit outflow in that short a period of time.
Yeah, well, there are many issues there. No, there were also governance issues which have been, so if some fraction of the regulatory findings would automatically have been made public, particularly the governance ones, one of the things that make this hard for us in Congress to deal with is that a lot of regulatory actions have to take place in secret. But if there was some fraction of things, for example, governance, that would automatically become public, would that have sort of lit a fire under you to maybe act more quickly on the risk gaps and so on?
Congressman, when the first discussion that I recall having with the regulators on governance, questions of governance, was in January of '22. And as soon as those conversations were had, we immediately reacted to that feedback. We didn't wait until the May 22nd or the May 22 letter. We immediately reacted to it and put together a whole series of programs and processes to make the improvements that were requested. So I don't believe that even if
you
it
don't
was
believe the
public,
threat
we
of
could
making
do
them
more
public would have accelerated that at all? Okay. So now, if during the period of your rapid growth, you had been forced to issue a contingent convertible debt, COCOs, as Asian banks and European banks are forced to, this would have forced a conversation with the bond market as to the risk position of your bank. And it also would have provided a capital buffer that you would have access to when you got in serious trouble. Would this have materially changed your behavior or the result? You can answer that. It's a complicated question. If you want to answer that in writing for the record, I'd appreciate it, because that's one of the things that I think both Chair McHenry and I think may be part of the solution here to make a more stable banking system. And I'd be interested in your thoughtful opinion on that.
Congressman, as mentioned in my written testimony, I don't have access to my information from the bank, and so I would do my best with the information that I have to be able to answer your
fair
question.
Enough. Yeah, fair enough. This will not be an exact calculation of what would have happened, but I'd be interested in your opinion. Mr. Shea, it seems like the most significant factor in Signature's demise was not so much a concentration in crypto assets, or deposits, but a lack of pledgeable assets immediately available for liquidity support. Are there changes in procedures or rules to make that more agile that you'd advocate?
I don't know the answer to that question. I do know that when we opened at the beginning of March 10th, we had $29 billion of pledgeable assets that were at the Federal Home Loan Bank and the Federal Reserve. And in terms of the ease of moving those assets, that was something that could be looked at in terms of making that.
We're gonna have to move on. The gentleman's time has expired. I now recognize the chairman of the subcommittee on oversight and investigations, Mr. Huizenga, for 5 minutes.
Thank you, Chairman Barr. Appreciate the witnesses being here and your candor. I'm going to ask you what I think are kind of two of the most important questions, frankly, and I'm going to go down the line asking you this. First is whether you take responsibility for the failure of your bank. Mr. Becker.
Congressman, as CEO, I think you have to take responsibility for the ultimate outcome of your institution.
Okay, appreciate that. Mr. Shea?
As chairman of the board, I think I did a responsible role throughout and fulfilled my duties.
Mr. Chairman,
Just a second. Is that, do you accept the responsibility for the failure, or do you believe it was other
very
management
sorry.
people?
I'm sorry that the bank was, seized by the regulators. I thought we had a responsible
bet your
plan
depositors
to
are
open
too.
the next morning.
Okay, so I take that as a no. Mr. Roffler?
Mr. Chairman, this was an event that is unforeseeable when it happens, and the contagion spread very quickly, and panic is very hard to control. What I feel responsible for is for our colleagues each and every day and our clients each and every day to make sure they're taken care of and supported during this time.
So that also sounds like a no. So congratulations, Mr. Becker. You're the only one to man up and actually take responsibility for that. I'll start with you. And since I can't get the other two to actually admit to their own failings, I'd like to hear from you. What would you have done differently in hindsight?
Congressman, that question to the point made earlier by Congressman Foster, I've thought about that a lot over the last several months. And when you look back at, and with hindsight, what could have been done differently, I think it's very challenging, because when you go back and make decisions, you have to go back and look at the facts that you had. And what I tried to describe in my written testimony is the facts that we had, that I had when I made my decisions, and I believe my team had when they made their decisions. And I truly do believe they made the best decisions, as did I, with the information that we had.
We're gonna explore that a little more, because yesterday you testified that SVB's capital and liquidity were validated by regulators in 2022. Your written statement points to an August 2022 letter sent by the regulators that conveyed the second highest possible CAMELS ratings of a 2, meaning satisfactory, on liquidity, capital, and market risks. Despite a downgrade of the liquidity rating in August, when you received the supervisory letter, were these ratings cause for alarm, or did you seem to confirm that you were on track? And then I also want to address something that you had said to Chairman Barr. You said that the Fed did not talk to you about the interest rate risk. They had 31 matters requiring attention, but none of them were about interest rate risk? Talk to me about that.
Yeah, Congressman, again, I'm going based on the best of my recollection.
Understand.
I don't recall a direct conversation about that. I know that in, I believe towards the end of 22, there was a matter requiring attention on interest rate risk that was issued. I was not in that meeting.
You said late 2022.
I believe that was in late 22.
All right. So until that time, just as you had confirmed, I'm confirming what you were saying to Chairman Barr, this was not an issue for the regulators.
Congressman, again, to the best
Yes,
of my recollection,
understand.
I don't recall.
Okay. Well, you had a memorandum of understanding to target matters requiring immediate attention. What were the major issues of that MOU to your knowledge, your recollection?
Yeah, Congressman, if I could clarify one point.
Yep.
The memorandum of understanding was never issued. It was verbalized to us. and it was verbalized us to in early 2022.
That doesn't really sound like a memorandum. It sounds like a conversation of understanding. Okay. All right. So did regulators follow up with you on the status of this MOU conversation or ask for your timeline or give you a timeline?
As I mentioned earlier, we were incredibly responsive to the feedback that we received at.
Real quickly, we've got 30 seconds. You testified yesterday that you offered several times to the FDIC to, quote, engage potential acquirers and run through a list of the names who you believed would be most likely acquirers. And every single banker I've ever talked to, big, small, or medium, has always had some conversations with competitors who might become allies. You stated that you offered your assistance, but the FDIC never consulted you in this. Can you confirm that, and why do you think they didn't? And did they give you any indication why they had no interest in your opinion on this?
Congressman, I can confirm that they did not engage me in reviewing a list or talking about any potential acquirers.
Sad. I yield back.
Gentleman's time has expired. I now recognize the ranking member of the Oversight and Investigation Subcommittee, Mr. Green, for 5 minutes.
Thank you, Mr. Chairman. Chief Executive Officer Becker of Silicon Valley Bank. Were you a board member of the Federal Reserve Bank of San Francisco?
I was.
Educated well in banking? Were you educated well in banking?
I've been in banking my entire career.
Yes. The Republicans, my colleagues, whom I love dearly, they seem to believe that failure to sufficiently punish you is a cause of the bank's failure. They've been alluding to this for days now. In fact, perhaps even weeks or more. Are you contending that because the regulators didn't punish you properly, your bank failed? That would be a yes or no, sir.
Congressman, we were
Sir,
very...
that would be a yes or no. Are you contending that the failure of regulators to punish you properly is a cause of the failure of your bank?
Congressman, we were
That would be a yes or no, sir. Would you contend that the failure, sir, of regulators to punish you is a cause of your bank's failure?
Congressman, we were responsive to the regulators.
The question is not whether you were responsive, sir. Please. Are you blaming the regulators for not punishing you? So if they had punished you, is what you're saying now, you would have done better. Is that what we'd understand? A man who sat on the Federal Reserve Board, highly educated, is that what we're to understand?
Congressman, as I articulated in my written testimony, there was a series of unprecedented events that all came together.
But that's not the question. You see, you are eschewing the answer and the question, I might add. The question is about you, your experience, and whether you're now going to blame a lack of punishment. You don't want to differ with them. They coddle you, I understand it. But this is a time for truth. You ought to speak truth, sir. You know that the failure of regulators to punish you is not the reason your bank failed.
Congressman, I believe the regulators, as the SVB management team, did the best they could with the information
Thank you.
that they had.
That's sufficient. I appreciate your saying that. Because for too long now, my colleagues have contended that it's the regulators who are at fault here. The regulators are not at fault. They have some things that they could have done, perhaps, and should have done. But at the end of the day, according to the Government Accountability Office, and according to the regulators who were here yesterday, the bank's failure lies with the banks at the end of the day. Now let me ask you another question, and this will apply to all three of you. Just raise your hand, because I can't ask you individually, I don't have enough time. Any of you conferred with the president about risk management and banking? If so, raise your hand. any of you, President Biden? There's a reason for the question. Let the record reflect that no one has raised a hand. The contention from my colleagues is that this is all President Biden's fault. Because of President Biden, you somehow made mistakes in your risk management practices. You didn't talk to President Biden. You don't base your decisions on news reports about interest rates that you can't validate, or at least have your risk management people give you some confirmation of. Any of you think President Biden caused you to make the decisions you made? If so, raise your hand. Let the record reflect that none of the witnesses has raised a hand. Finally, this. Do you think that the bonuses received, Mr. Becker, Chief Executive Officer, should be returned? The bonuses received at or near the time of the collapse of the bank should be returned.
Congressman,
That would be a yes or no. The
expect to
chair is ready
cooperate
to
with
sound
the
the hammer.
process that's going to be given.
Yes, but do you think they should be returned?
Congressman, I will cooperate with the process that I know will be.
Well, we're going to have some clawback legislation for you to cooperate with. I yield back.
The gentleman's time has expired. The gentleman from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you very much, Chairman Barr. We heard an exchange a while ago from a member on the other side said when he got here in 2008, he was reminiscing some of the circumstances. They weren't very pretty. But one thing that was resolved by the party in charge at that time to make sure that we never had another bank failure or an economic crisis, they established the CFPB, the Consumer Financial Protection Bureau. And among its charges was to make sure we never had any more bank failures. And I'm just wondering, did you have any contact with the CFPB, Mr. Becker?
The CFPB was one of our regulators, but given that we were predominantly a commercial bank, the interaction with the CFPB wasn't as significant as the other regulators.
It was less significant than with the other regulators, did I hear that correct?
Than the Federal Reserve and the state and the FDIC.
Okay. Mr. Shea, same question.
In my role as chairman, I don't recall ever meeting anyone from the CFPB.
Okay. Mr. Roffler, same question.
I don't believe I've met with anyone from the CFPB, but they did periodic exams and visits to First Republic.
Okay. Do you think the CFPB, Mr. Roffler, could have been more helpful in helping you avoid?
I think that the CFPB, along with our other regulators we interacted with, we ensured we had a very professional and open relationship. We shared with them what the bank was up to and what the strategy was and how our results were. And they did thorough examinations, and we responded to any feedback.
Okay. Mr. Becker, did you sell, convert, or otherwise affect any of your stock in the 12 months preceding?
There was no stock that was sold in 2022.
A little bit into the mic, I can't hear you well.
Yeah, there was no stock. I didn't sell any stock in 2022. And in 23, I sold after our earnings release, after it was reviewed by our legal team and myself, that I didn't have inside information. We put a 10b5-1 plan in place in January, and that was sold with expiring stock options from 2016.
How much was that, the value at the time of that, probably?
The gross amount was $3.6 million.
Okay. Mr. Shea, same question.
I sold no shares I sold no shares in 2022, with the exception of reversing 3 shares that were accidentally bought in my account, which were then sold back. Those were 3 shares. And indeed, I purchased shares throughout that period.
2023?
2023, I purchased shares on March 10th, 2023.
Okay. Mr. Roffler?
I transacted twice, once in 2022 and once in early 2023. Both of those transactions were made with the approval of our policy and procedure and our general counsel, and they were also made following disclosure of financial information to the market, one, through our investor day, and number two, through our earnings release. And the last thing I would say is that it represented a portion of my shares, and the vast majority I retained.
Yeah. What were the dates and amounts of those transactions?
One of the dates was about November 15th or 16th, and it was just over $1 million. And the other date was around January 19th or 20th, roughly the same amount.
Okay. I see my time is about to expire, Mr. Chairman. I yield back.
Gentleman yields. Gentleman from California, Mr. Sherman, is now recognized.
Thank you. One thing I've commented on is the idea that the Federal Reserve regional boards are not selected through democracy and the voters of this country, but governmental power is given to those who are elected by banks. And they elected Greg Becker. I'm not so sure it's a good system. We ought to have all governmental power in this country in the hands of the executive, judicial, or legislative branches of government. One bank, one vote is not democracy. After hearing the near tearful presentations by these CEOs of their dedication to their customers and employees, I guess they want us to say thank you for your service. Can't say that. My Republican colleagues are in this desperate effort to defend corporate malfeasance with their old strategy of blame Biden. The fact, what they've suggested is that we shouldn't have fought inflation and Americans should be paying higher prices. We should have managed all monetary policy so that the three worst run banks in America would survive. Talk about the tail wagging the dog. This was not a 100-year flood. We saw 16% interest rates under the Reagan administration. I didn't say the Harding administration, the Reagan administration. This was a modest rainstorm, and three of you went down. 99.5% of the banks survived this modest storm. The reason these banks went down is because recklessness and greed. The bigger the bonus, the bigger the risk, the bigger the bonus. And I'll illustrate that in a bit. We shouldn't be blaming the depositors. The depositors didn't take their money out of profitable banks. They didn't take their money out of solvent banks. This is not just a liquidity problem. The strongest bankers in this country looked at Silicon Valley Bank and determined that it was worth negative $20 billion. If anyone has their money in a bank where the net worth is under is a negative $20 billion, it's time to get your money out of that bank. Let's talk about, okay, so Silicon Valley Bank virtually doubled the duration and therefore increased the yield of the securities that it held. That led to bigger risk, higher profits, and more money in Mr. Becker's bonus for the 2022 fiscal year. Then Silicon Valley Bank at the end of 2021 had 56% of its available for sale portfolio hedged through credit default swaps. In other words, they had insurance on this 56%. They saved money, cut the insurance down only 2% of the portfolio, lower costs, higher profits, bigger bonus. So it's not surprising that these are the banks that went down. Mr. Becker, you've said you take responsibility for the collapse of your bank. Are you willing to return the bonus that you got the day before the bank failed and that you then took on your Hawaiian vacation?
Congressman, as I said earlier, I plan to cooperate with the process.
Will you do it voluntarily or only if the government forces you to?
Congressman, I will cooperate with the
Cooperate,
process.
that means only if the government forces you to. Will you voluntarily return that portion of the bonus directly attributable to the bank's higher income for 2022 because you went to longer-term, higher yield securities?
Congressman, I will cooperate.
In other words, only if forced. And will you return that portion of the bonus attributable to the money you saved by throwing away your flood insurance as it began to rain, or cashing it in, and not having hedges and credit default swaps on your portfolio? You return that part of the bonus?
Again,
Not voluntarily.
cooperate with the process.
Mr. Becker, you testified before Congress in 2015 that having tough regulation would divert significant resources of the bank to complying with enhanced prudential standards and other requirements. So we have less regulation of your bank. How'd that work out for you?
The gentleman can submit his answer in writing. The gentleman's time has expired. The gentleman from Missouri, Mr. Luke DeMeyer, the chairman of the National Security Subcommittee, is now recognized.
Thank you, Mr. Chairman. Welcome to the guests this morning. Gentlemen, as tragic as the situation is, I think it's also a learning moment for all of us, an instructive moment, I think, for us in Congress and for the regulators and for bankers around the country, quite frankly. From the standpoint that I think we're in a new world now with regards to social media and the actions that can be taken, the actions that can have adverse effect on our financial system, our culture, our economy, and I'm very concerned about it. Each of you in your testimony mentioned that Mr. Becker, $42 billion went out to your bank in 10 hours. Mr. Shea, $16 billion went out in just a few hours. And Mr. Roffler, I missed the number on yours, but again, you had the same situation where social media excited people to the point where they ran out, changed their banking situation, and as a result, a lot of the uninsured deposits in your bank ran out. I would like for you to give me your analysis on this. Was the FDIC tracking this with you as this was happening so that they were aware of this, or were you notifying them at all as this money was running out the door? Mr. Becker?
Yeah, Congressman, we notified the regulators that we were doing the capital raise, so they were aware of that. And when the bank run started on March 9th, I was not directly involved, so I can't say the exact discussions that were happening, but to my memory, to my knowledge, our risk team and our regulatory affairs team were engaged in conversations with the regulators.
Mr. Shea?
As chairman, I don't know precisely I don't know the conversations that were taking place between Treasury.
Was there contact, I guess, is the question.
Excuse me?
Was there contact between your bank and the regulators with regards to the amount of money that was flowing out?
I would defer to management. I don't know the...
Mr. Roffler?
Thank you, Congressman, for the question. As I mentioned in my testimony, we always had an open working relationship with the regulators. That included, as the contagion spread on March 10th, we had multiple meetings in the morning all the way through the evening that day, reviewing our funding and our liquidity and what was happening at the bank.
All of you having gone through this, what do you think is a realistic situation that we need to be considering here? And I sit on the China Select Committee, and this scares the dickens out of me, quite frankly, because I'm sure the Chinese are watching us play funny business with our own banks and our own economy. Do you think, having gone through this is a very real concern, or am I overreacting to this? The short selling is going on right now, not to the extent it was, but can social media have the kind of effect on this that could actually directly impact or could crash our system? What do you think, Mr. Becker?
I think we are evidence of that, and I think it's something that needs to be looked into to determine how best to protect against it.
Mr. Shea?
Thinking back to that Friday, those few hours, and I remember talking to depositors who were so panicked. I started my career, I was on Wall Street during 1987. The panic that was flooding through social media. People were saying they didn't want to hear about solvency, that the bank was solvent. They didn't want to hear about $29 billion of liquidity. They didn't want to hear about rating agencies, ratings. They didn't want to hear about anything. They just wanted to hear they had to get their money to a too-big-to-fail bank, and they needed to do it immediately.
Mr. Roffler.
Yes, Mr. Congressman, it's very challenging, and the panic was very real. And as I spoke with clients too, at the end of every conversation, if they decided they wanted to do something different, we facilitated that and helped them. But it definitely was started with the contagion that spread to us from the activities the day before.
This really concerns me because I think, back in 2020, we had a run on toilet paper of all things. And I think people will prioritize their money over toilet paper. So we already have 3 examples here. And I think the regulators took some actions to minimize this contagion effect across the system. Whether it was enough or not in time, I'm not sure. But I think it's something we need to certainly look at and study. Vice Chairman Barr was here yesterday, and he made the comment that the core responsibility of examiners is to look at interest rate risk and liquidity risk. Mr. Becker, were the examiners looking at credit, interest rate risk and liquidity risk in your bank?
Congressman, liquidity risk, I know for certainty that was discussed, and I don't, again, as I mentioned earlier to answer your question, I don't have direct experience in hearing about interest rate risk, but I'm confident it happened.
Okay, thank you very much.
Gentleman's time has expired. The gentleman from Georgia, Mr. Scott, is recognized.
Mr. Becker, over here, what percentage of your deposits at Silicon Valley exceeded the FDIC's insurance cap just before the bank collapsed on March 10th of this year?
Congressman, as I mentioned in my testimony, I've been at SVB for 30 years, and to my recollection, we've always had a high level of uninsured deposits. It was not that different at the end versus what it was a year earlier.
I'm sure that the whole nation, the whole world knows you had a high percentage. But, in fact, according to the S&P Global Market Intelligence data from December 2022, we now know that Silicon Valley Bank ranked first among banks with more than $50 billion in assets, with 95% of its total deposit being uninsured. That's the truth. And for you not to know that, for you not to answer that, is absolutely unbelievable. While the average for U.S. banks was 30%, you had 95%, almost all of your accounts, uninsured, according to the S&P's Global Market Intelligence. Not only exceeding the FDIC's insurance cap, but doing so with this 95% in high concentrations in the technology sector, making your bank highly susceptible to panic. I think you're going to go down in history as absolutely being the most irresponsible leader of a bank in the history of this country. To have 95%, almost all of your accounts uninsured. So not only were you exceeding the FDIC's insurance cap, but with this technology sector, making your bank highly unsusceptible to panic. So let me ask you this, Mr. Becker. At any point leading up to March 10th, were you made aware of regulators' concerns regarding your bank's over-reliance on 95% of your bank accounts being uninsured deposits?
Congressman, to my earlier point, given we're a commercial bank, we've always had a high level of uninsured deposits. And to my memory, that
A high level, you keep saying a high level, all of them. Even, I can't even imagine you're thinking at that. And you're thinking the American people are not highly disappointed in your total disregard of their money in your hands, and you're not having it insured. Less than 5% insured. Now, let me ask you this. Who made the decision to maintain this reliance on uninsured deposits, given the warnings also by our federal regulators? Who made this decision, Mr. Becker, this foolish, irresponsible, and deceitful decision? Who made it?
Congressman, as I said, that's been our business model for as long as I
Who
can
made
remember.
the decision, my friend?
And that information.
Was it you?
The gentleman's time has expired. He can submit an answer in writing for the record. The gentlewoman from Missouri, Ms. Wagner, the chair of the Subcommittee on Capital Markets, is now recognized.
I thank you, Mr. Chairman, and I want to thank our witnesses for appearing before the committee today. The reckless actions by you and your management put the paychecks of millions of Americans and thousands of businesses, some of which were in my district, Missouri's 2nd Congressional District, at great risk. The week SVB failed, I had businesses that provide good jobs in my district left wondering if they would be able to even make payroll the following week. Now, yesterday, we discussed the supervisory failures, abject failures of the prudential regulators. It's now abundantly clear that they should have taken stronger enforcement actions after many, many citations, MRAs, MRIAs, to prevent these collapses from happening. Today, I want to hear from you all as to why your banks were insufficient in addressing a rising interest rate environment that started over 12 months ago. Mr. Becker, as interest rates increased at the most rapid pace in modern history because monetary policy had to battle runaway inflation, did supervisors at the Fed show extra attention to interest rate risk issues? And if they did, when did they begin to show that attention?
Congresswoman, as I mentioned earlier, when I look at the supervisory findings, we had one MRA regarding interest rate risk, and it was mainly related to modeling. To my memory, I don't recall that coming up as a major topic. What was the discussion that had been had, the main one was around liquidity. And we, to my knowledge, addressed all or the majority of those findings during 2022.
Mr. Becker, by March 8th, 2023, when SVB announced that it was selling the available for sale portion of its securities portfolio, the Fed had already implemented 9 interest rate hikes. Why didn't SVB attempt to sell these securities sooner?
Congressman, the decisions around when to sell the securities and what to do is monitored and managed by our Asset Liability Committee and our Treasury team and overseen by our Finance Committee of the Board. The first time that I recall coming up about the possibility of selling our available for sale portfolio was in the fall of, or towards the end of 22, and it was decided that that at that point, it didn't make the most sense. There was a belief that the rapid rise in interest rates could create and likely would create a recessionary environment, and rates would actually start to go the other way. In the beginning of 2022 or 23, we realized that that was unlikely to happen, and we decided to then sell the portfolio.
Okay, Mr. Becker, the Fed report notes that prior to 2022, Silicon Valley Bank had interest rate risk hedges on some or all of its longer dated maturities. The Fed report further notes that over the course of 2022, the bank pursued a strategy of dropping those hedges. Can you explain why you made the decision to drop these hedges?
Congresswoman, 2 points, and I'll get to the answer to your question. The hedges that were in place, again, set up by our Asset Liability Committee and our Treasury team, were only on a portion of our available for sale portfolio, which was a much, much smaller portion of the securities portfolio. So I don't recall the specific percentage, but it was actually a small percentage of the overall portfolio. As far as the decision to sell the hedges, that decision was made by our Treasury team and our Asset Liability Committee.
Wouldn't it have been more beneficial to your balance sheet to have kept those hedges as long as additional interest rate hikes were on the horizon? I mean, if the Fed was clearly going to keep raising interest rates.
Congresswoman, I don't know the exact rationale behind it. I don't have that information.
Such poor mismanagement. So reckless. There's so many paychecks, 2 million that were on the line, many of which in my own district. I'm just disgusted. Following up to Mr. Huizenga, I'd like you to answer this in writing. We were talking about your engagement with the FDIC of a potential acquirers. You said that they did not engage you. I want to know if you were surprised that the FDIC did not take you up on that offer, and if you knew how many acquired. But you can send that to me in writing. Thank you. I yield back.
Gentilady yields back. The gentleman from Massachusetts, Mr. Lynch, is recognized.
Thank you, Mr. Chairman. I want to follow up on the gentlelady's line of questioning. Mr. Chairman, I'd like unanimous consent to enter into the record an article from the New York Times dated December 15, 2021.
Without objection.
So this article basically says that the Fed had made clear, this is December of 2021, Mr. Becker, and it says that a fresh set of economic projections released on Wednesday showed that Fed officials expect to raise interest rates, which are now set near zero, 3 times in the following year. So this is December. This is December of 2021. The Fed went ahead and raised rates 7 times in the following year, but said they were going to raise them 3 times. And you were still loaded up with long-term, low-interest securities that were uninsured. So you basically failed to anticipate the impact that a rising rate environment would have on those deposits, no?
Congressman, as I mentioned in my written testimony, and I think this is very important, our balance sheet is constructed, our asset side, with securities and also loans.
I get that.
Those loans are variable rate, meaning as rates rise, we make more money. And so my view is you have to look at the entire balance.
You had 97% of your deposits were uninsured. 97%. Those are the first deposits to run. These are the Kenyans of bank deposits. They run the fastest and they run first. And you failed to appreciate what would happen when rates went up. But the Fed told you, the Fed made public their intent in December of 2021 that they were going to raise rates. So I realize you didn't have, is this a period where you didn't have a chief risk officer? Is this correct?
No, it is not.
It's not. So what did your risk officer advise you at that point?
Congressman, I don't recall specifically what the discussion was around that. I know that, again, my memory is that.
So look, it shouldn't take a risk officer to figure this out. I mean, if look, so you had $91 billion of assets that were locked into long-term, low-interest securities. $91 billion. And as rates went up in 2022, the value of those assets plummeted, went from $91 billion to $21 billion, and everybody headed for the door. How could you not anticipate that? How could you not understand the impact of a rising rate environment on your deposit base? I don't get this. And I find it hard to believe that no one at the bank anticipated this. What's your response?
Congressman, what is the specific question?
The question is, what was your alternative reality if you're not facing the facts, and if you're not acknowledging what's going on in front of you? What was the alternative scenario, the alternative reality that led you to keep these, and these were many of this, so this $91 billion in assets were held to maturity. So that really frightened people when you had to start selling those at a considerable loss and actually realizing the losses of this strategy. And I'm just asking for an explanation of why you did what you did in the face of what was going on.
Congressman, it's a complicated answer in the sense of looking at the balance sheet. You have to understand the assets, and again, our loans were variable rates, so they benefited from higher rates. So that's part of the equation. The other part
Here's what gets me. So earlier in your testimony, you're blaming the Fed for not telling you what to do, not raising the interest rate issue with you, when, a high school student in economics or finance would be able to figure out the danger that you were in. Mr. Chairman, I yield back.
The gentleman yields. The gentleman from Texas, Mr. Williams, is now recognized.
Thank you, Mr. Chairman, and in full disclosure, I'm a car dealer from Texas. And Mr. Shea, in the recent New York State Department of Financial Services Internal Revenue review regarding the supervision of Signature Bank, it showed that your bank did not develop a control framework in line with its growth and did not have a liquidity management plan that matched its risk profile. In the past and leading up to Signature Bank's collapse, regulators had identified weaknesses in the bank's liquidity risk management, yet Signature's management failed to act on or remedy these warnings. You are in the position you are in right now because you failed to adequately manage your liquidity risk and positions. So my question is, when you were made aware of these liquidity risks, and why were they
should be
ignored, and
scrutinized.
did you express any
At the time of its failure,
disagreement with the
SVB had
Fed regulators'
31
findings
open
when they were
supervisory
laid out
failures
to
or
you?
warnings from regulators, and yet nothing was done. It
yes, as
was
chairman
not
of the
gone
board,
unnoticed that
I
your
was
position on
aware
the
of
Fed's
these,
board of
and
directors
the
potentially
bank was
created
taking
a relationship that
substantial
impeded
steps to
supervisors'
address them,
judgment
including
and
improving
created
stress
some of that
test modeling,
leniency.
improving
And for their
other
part, the
modeling,
Federal Reserve missed or
diversifying
ignored
further
all of the
deposits,
signs. And when they
portfolio
did
mix,
react, it
limiting
was
the
too
amount
late.
of deposits.
Yesterday, in testimony before our committee,
seeking
the Vice
additional
Chairman of
sources
Supervision,
of liquidity
Mr.
in
Barr,
terms,
the other Mr.
additionally,
Barr,
including
at the Federal
issuing
Reserve,
brokered
admitted
CDs,
that we
which the
have
bank had
all
not
what we have all
previously
known
done
for
that were
months: the
insured,
failure of your
entering into
banks
repurchase
was a result of
agreements
failed
or
supervision
arranging to get into
under his
repurchase
watch.
agreements,
He finally
negotiating
admitted
repurchase
that
agreements with
he had the
primary dealers,
responsibility of that. However,
curtailing
federal
lending
regulators will attempt
to
to use these
lower
bank
the
failures to
amount
exercise
of,
more and more
need
authority
for
well outside the
deposits
bounds that
and
Congress established for
maintaining
them.
a
And the notion that
high-quality,
these failures were a result of
a
regulatory
high-quality
changes is
security, a
unfounded.
high-quality
As we heard
lending
from the
portfolio, as
GAO,
well as
their
a
reports about the Fed
shorter-term
started in
securities
1991,
portfolio
not
consisting of
2155. It was
readily
1991.
marketable,
Nevertheless, regulators will try to
government
shift the blame, but
agency
the
and
facts
other
are clear.
securities.
All right.
And in testimony
In
before our
2022,
O&I
we saw the
subcommittee last
Federal
week,
Open
the
Market
GAO
Committee
flagged those
raise interest
concerns
rates at a
in
speed that
supervision
we've
and
not
enforcement
experienced
practices
since the 80s, and
going
I
back to
remember the 80s.
1991.
And a
The
belated
report
attempt to
concludes that
address the
all three
runaway
federal
inflation
financial
sparked by the
regulators
Partisan
have,
American
quote,
Rescue Plan,
wide
which
discretion in
injected
choosing
$1.9
from
trillion
among
into the
enforcement
economy.
actions of
This
varying
rise in
severity,
rates
close
caused the
quote.
assets at the
Lastly,
Silicon
an
Valley
independent
Bank
assessment of
had
these events
invested
is not only
into
appropriate,
decline
but
in
it's
value.
desperately
We know
needed.
this, and when withdrawals at
This committee is committed to
SVB
providing
began
the
to
American
rise
taxpayer
at a
with an
rapid rate,
unfiltered review of the
assets
events
were sold
that
at a loss.
preceded
So
these
Mr.
bank
Becker,
collapses, and ultimately,
when the
they
bank
bear the
invested
cost
$80 billion in
of your
long-term
failures.
mortgage-backed
I look forward to hearing from
securities,
each of you
was
as
there
we
a plan
continue
in
to seek
place
these answers. And
to
Mr.
adapt
Chairman,
to
I yield
rising
back
interest
the
rates
balance
and
of my
The
decreasing
gentleman
value
yields
of
back.
these
I now
assets- of these
recognize the
bonds?
gentleman from Texas,
Ms.
Ranking
Wagner
Member of
touched
the
a little bit
Oversight
on
and
that.
Investigation Subcommittee, Mr. Green,
So
for 5
Congressman,
minutes.
Thank you,
a
Mr.
couple
Chairman.
of points. One is
Mr. Chairman,
that
holding
investments that were made in
this oversight
2021,
hearing today
those were
with
invested
the former
in
chief
government
executives
securities,
of
and
Silicon Valley
those are
Bank
very
and
pledgeable.
Signature Bank
If you need liquidity,
will
you can
allow
borrow against them.
important
And by the end
questions
of
to be asked
2022,
and answers to
we
be
had
received
$69
from
billion
those who
of
nurtured
availability for
the root
liquidity
cause
at the end of the year.
of their
Second
bank's
point
collapse.
is that those securities actually
At yesterday's
paid out.
hearing,
So
regulators
roughly $12
acknowledged
billion
their shortcomings.
per year.
Today's preeminent question is,
amortize down.
will
And that was from
today's
the held-to-maturity
bankers
portfolio.
acknowledge their
We also
faults?
had availability with
Will they
our
take
available-for-sale
responsibility for the more than
portfolio, and then our
70%
cash.
uninsured
So
deposits
when we
that
looked
alarmed
at it,
depositors?
we believe we
Will
had
they acknowledge both
adequate
Silicon
liquidity
Valley Bank and
to
Signature
support
Bank experienced
several
outsized
different
growth
scenarios.
between 2018 and
And
2022?
Mr. Becker, finally,
And
the
that
bank did not
Signature
have a
Bank
chief
grew
risk
from
officer. I think you
approximately
talked about that
$47
for 8
billion in
months
total
between April
assets in
22
2018
and January
to
23.
$110 billion in
It seems as if your team
2022.
did not care about risk.
That
And even
Silicon
though
Valley
there were
Bank
several warning
increased
signs
from
that had been brought to
$56
light, you and
billion
your team
to
did not think
$209
to
billion
address the
over
risk
that
and
same
someone in
period of
place to
time.
manage and mitigate those risks. So you
Will
did,
they
however,
admit
bring on chief
that
risk
this
officer in
outsized
January,
growth
but then proved to be
in
too little too
assets
late. So Mr. Becker,
was
quickly,
fueled by
during
more
the
than
time that Silicon Valley
70%
Bank did not have a
uninsured
chief bank
deposits
officer,
at
who
both
was
banks
overseeing the risk management
or
framework, and what
far
efforts
higher
did you make
than the
to
median of
find and
32%
hire a
for
qualified
comparable
candidate?
banks? Will they
Congressman, I
confess
respectfully disagree with
that the executives at
characterization that we
both
didn't
banks
take risk
knew
management seriously.
or should have
I didn't have anybody in
known
charge, but
that their risk management
We had a
practices
team of people,
had to
of
be
senior
strengthened
executives in risk
appropriately as
leadership
they grew
positions.
in
We
size
created the office of the
exponentially?
CRO, Chief Risk Officer, that reported
Will they
to me
concede
and reported into the chair
that it
of our
was
risk committee.
irresponsible
And we were
for
actively
Silicon Valley
engaged
Bank
in risk
to
management
operate without
broadly
a
across the
chief risk
organization and being
officer
responsive
from
to the
April
regulatory feedback.
until December
kind of like in my car
2022?
business, selling cars, but
Will
don't
they
have sales
agree
management.
that those who nurtured
I
the
yield.
root cause of a bank's
Gentleman
collapse
yields. The
should
gentleman from
return
Ohio,
any
Mrs.
bonuses
Beatty, is now
received
recognized for 5
as the
minutes.
collapse came
Thank you,
to
Mr.
fruition?
Chairman. Thank you, Ranking Member.
Will they
I'm
allow
not sure where to
and
start.
avow that
So
upon
let me
Silicon
start with
Valley
making
Bank
this statement.
having received
I want to
13
take a
of the
moment,
most
Mr.
serious
Chairman, to
supervisory
acknowledge
warnings
the
the Fed
hardworking
can issue,
Americans
the
who were
bank's
harmed
officers
by this
should have
glaring
taken corrective action.
mismanagement at your
And
banks. Public pension funds
will they come
nationwide
clean
lost millions of
about
dollars
Signature Bank's
that were
failure
invested in the
to
Silicon
take corrective
Valley
action
Bank and Signature.
after having
In my
received
hometown,
9
in my
matters
3rd
requiring
congressional
board
district, the
attention
home of
notices
Ohio State Teachers
from the Federal
Retirement
Deposit
System,
Insurance
took
Corporation,
the biggest hit.
including
Over
3
$27
specifically
million
related to liquidity
invested in your bank.
or risk management.
Meanwhile, with the reports that
Mr.
have come
Chairman,
to light since the bank's collapse
the time
in March, we
for
know that
atonement
executives at your
and
bank
recompense
earned
is at hand.
millions of dollars in bonuses,
Today
stock sales,
provides us the
increased
opportunity
executive compensation
to hear from those
while you
who had
ran
a
the banks
hands-on
into the ground.
experience
And I don't need to go through it. We've heard it
with
on
the
both sides of the aisle,
failure
from failing to address
these banks.
supervisory recommendations,
These
taking on
persons were capable,
significant
competent, and
interest
qualified.
rate and liquidity risk,
They all
and inadequately
have degrees
matching the bank. Meanwhile,
indicating such,
teachers,
and they have experience
like my sisters,
connoting such.
firefighters,
should
and other public
have
servants lost
taken
millions
corrective
that
action.
were invested through your public
They will be
pension
given the
funds.
opportunity to
So let me
answer
do
these
two
questions
things
that I've
quickly.
called to the
Mr.
attention
Scott ran out of time.
of not
so
only
any
this
one of
committee,
you can
but also
answer, his
of this
questions.
country. The
Who
people
made
of
the
America
decisions
need to know
to continue with
what
these
happened at these
uninsured
banks.
deposits.
This is the
We'll
time
just go
for
down
us
the
to
line.
find
Just
out.
give me an answer.
I
Who
yield
made
back
the
the balance of my
decisions, Mr.
time.
Becker?
The
The gentleman yields back. I now recognize the gentleman from North Carolina, the chairman of the full committee on
has been our
Financial
strategy.
Services,
So who
Mr.
implemented
McHenry,
the
for
strategy?
2
Who
minutes.
did
I
it?
want to thank
Who
Chairman
made the
Barr and
final
Chairman
decision?
Huizinga and the ranking
The
members
strategy,
as well.
direction
At today's
of
hearing,
SEB
So is your
is
you'll,
signature
will
on it?
hear
Do you
three
take
different
responsibility
stories
and
from
myself.
Do
three
you-
different
okay,
banks.
Thank you again, and thank you.
Your business models were not the
for
same.
acknowledging and taking
Your depositors
responsibility. Mr.
were not the
Shea,
same.
We'll go on. Second,
The
your
degree
answer.
of mismanagement was not the same. in the midst of
Yes,
this.
the strategy.
So does that mean you take
was
responsibility?
to
Bears
serve,
responsibility as the captain
the
of the
strategy
respective
was to
ships.
serve mid-sized
And we've heard
mid-sized
that.
companies.
Okay, but do you take the responsibility
There
for
was
that
a storm
strategy? You know,
brewing,
strategy
and
is
you
a
failed to
word.
batten
Who
down the
implemented
hatches.
it? Who was ultimately responsible?
And while
Was that you?
inflation raged, the
That was the
Fed
founding
and the Biden
principle of
administration
Signature
told
Bank.
us it was transitory.
Same question.
Nothing to worry
The
about.
Board of Directors and Executive
We'll
Management
get into the
implemented a
management
successful
question shortly,
business
but
strategy that lasted for 37
one of the mistakes
years.
Okay, because the clock is
is
running.
that
Let me go into
these
the
three
next question,
bankers
please.
actually
Okay, now I've
believed
heard
the
you've been there
bureaucrats.
30 years, 12
We all know
years, the
inflation was
CEO, a
not
lot of time.
transitory, and after being
Founder
late to
since
respond, the Fed was forced
2000,
to raise rates at the
co-founder,
fastest
of
pace
Signature
in
Bank.
modern history.
CEO
And
since
again,
2009.
you failed to
to
appropriately
present.
prepare for
Okay,
this
how much money
inflationary and
did
high
you
interest
make? What
rate
was your
environment.
salary for 2022 and 23 and
Silicon Valley
bonuses?
Bank
Salary
was
and
the
how much you buy?
projectile that set
Bonuses,
this
dollars and
volatility
cents.
into motion.
For
The Biden administration
2022,
used
Yes.
another word to
salary
describe
was just
SVB.
over $1 million, and my
Idiosyncratic.
incentive compensation was
Well, clearly,
$1.5 million.
as there are three of you
Next.
today, three of the 30 largest
My
banks
salary,
in American
my
history,
last salary was
in America
$900,000
today.
and $1.7
The problem
million.
goes much deeper. The subsequent
last salary
failures
was
of Signature and First
$990,000,
Republic,
and my
coupled
bonus
with the
was
volatility in
$1.5
regional
million.
bank stocks,
Okay.
sent shockwaves through our
Do
financial
you
system.
know, let me
The
start
fear of
with you,
contagion has
Mr.
rocked an
Becker.
already shaky
You know
economy.
what MRA
So
stands
we'll hear
for
from
in
each of you today and the
MRIA,
New York
right?
and California bank
Okay.
regulators as well.
So,
I think it's
same
important
for
to take a
everybody.
step
You
back and
understand
really
what
examine the
that is, right?
undercurrents that caused this
Okay.
crisis.
So,
The economic
Mr.
mismanagement
Becker, in the
by
recent
the
report
Biden
on the
administration
failure of
that
Silicon
created the
Valley
perfect
Bank
storm
and the Federal
that
Reserve
each of you
stated that
failed
it
to right
issued
your ship in.
multiple supervisory issues on MRA and on MRIAs.
The gentleman yields back.
31
Today we welcome the
supervisory
testimony of
issues
Mr.
pertaining to
Greg
capital
Becker,
planning
former CEO
and
of Silicon
positions,
Valley Bank.
liquidity,
Mr. Scott
and risk
Shea,
management,
co-founder and
governance
former
and
chairman of
control,
Signature
all
Bank.
these strategies you
And
all
Mr. Michael
talked
Roffler,
about,
former
including
CEO and
Bank
President, First
Secrecy
Republic
Act
Bank.
and the
We thank
anti-money
each
laundering.
of you for taking the
okay?
time to be here.
12
You will
of
each
the
be recognized for
31
5 minutes to give
open
an oral
issues
presentation
on the
of your testimony.
MRIA.
Without objection,
And for
each of your
those
written
watching
statements
that
will be
don't
made part
know,
of the record.
When you put
Mr.
the
Becker,
I
you are now
in
recognized
it
for
means
5 minutes.
immediate. That means it needed immediate attention.
Chairs Barr
Can you
and
explain
Huizenga,
to me
ranking members
after
Foster and
3
Green,
years
and
why
members
we
of the
still
subcommittee.
had, and up at the collapse,
Thank you for the
we had
opportunity to
not
appear
answered,
before
you
you
had not
today.
answered
My
those
name is Greg
31.
Becker.
Only
I was
12.
the CEO of Silicon Valley Bank. Congresswoman, as I said earlier, we were today extremely to answer your responsive to questions the about regulatory what feedback happened at and SVB, all the matters you're to the best of my describing. memory.
Do you know
We're
what
in
those
process.
12 are?
At the
Because my
outset,
time is
I
right
want to
now.
be clear
Do
that
you
I
know
never
what they
envisioned
were?
myself where SVB
I can't
being in this
speak to every
situation.
single one, but I
was
know
an employee
that.
for
I'm sorry,
SVB for
my time
nearly
is
30 years and CEO for the
The
last
gentlelady's
12
time
years
has
until it
expired.
was taken
The
over by the
gentleman
FDIC.
from Georgia, Mr.
I believed in the
Loudermilk,
bank
the vice
and its
chairman
mission
of the
and
committee.
care
The
deeply
subcommittee is now
about our more than
recognized.
8,000
Thank you,
employees
Mr. Chairman,
and their families.
appreciate you all
I was
being
committed
here
to our
today. This
clients
is
and
a
helping
very
them
important
succeed,
issue,
whether they were
as, you
well-known
are all
tech
aware.
companies or small business
Mr.
founders
Becker,
in towns across the country.
Chairman Andy Barr asked you
SVB was
about,
designed to meet the needs of
departure
technology and
the
life
Chief
science
Risk
industries
Officer
where
for
startups and
Silicon
later-stage
Valley Bank.
companies could keep their
In
deposits,
yesterday's hearing before the
borrow
Senate
to
Banking
expand their
Committee, you
businesses
said
and
that
create
this was
jobs.
spurred at least in part by
We knew our
recommendations
clients
from
personally,
regulators who
understood
were
their needs and
concerned
goals,
about her experience.
partnered
Can
with them
you tell us a
as
little
they
bit
grew.
more about the specific concerns
We
the
took risk management
Fed regulators
seriously
had about
and
your
worked closely with
CRO's
and were responsive to the various regulators who oversaw
as I described
SVB.
yesterday, the feedback was
Over time,
observations from
we built and
the
expanded a
board of
team of
directors,
subject matter
from,
experts
the
focused on
regulators,
analyzing risks and
from
protecting the
myself,
bank.
internal
We
audit.
continually sought
And
to add operational
as we started to
expertise and
approach
experience to
$250
enhance
billion
our risk
level,
management as the
looking
bank
at individuals,
and its clients
especially in the risk area,
evolved.
that had that experience of even
Much has been
larger
said about the
institutions
takeover of
was the
SVB by the
feedback that we were
FDIC
getting.
and why it
And so
happened.
that's what we acted on.
Ultimately, Personally, I believe that
But
SVB's
according
failure
to
was brought
her
about by a
public
series
LinkedIn profile,
of
she had
unprecedented
over a decade of
events.
experience in enterprise
Between
risk management
2015 and
prior to her 6
2019,
years at
SVB grew from
SVB.
about $45 billion in
In her
assets
6
to
years of
$71
employment
billion in
with you, what
assets
role
at
did
an annual
she
rate
play
of
in
about
have-
10%.
in developing the bond portfolio?
This
that
changed in
contributed to
2020
SVB's
due to the COVID-19
collapse?
pandemic and the government stimulus
Chief Risk
measures.
Officer
would have sat on our with
asset
near zero
liability
interest
committee,
rates and the largest
and she
government-sponsored
would have been a voting
economic
member
stimulus
on
in
that
history.
committee.
Given
More
that
than
$5 trillion
wasn't on that committee and
flooded into
wasn't
commercial
part of it.
banks in the United
I
States.
don't know the discussions that she
By the
would
end of
have had
2020,
in
SVB
overseeing
had grown
the,
63% over the
overall
prior year,
portfolio
and
and
in
the strategy around it.
2021, SVB's assets
I
grew
understand
another
it
83%
takes time to find good
to $212
executives.
billion.
But why did you
support this
decide
growth,
to dismiss her
SVB
without
raised
having
more than
a
$8
successor
billion
already in
of new
place?
capital in 2021.
As I mentioned earlier, based on the
Importantly,
feedback, we
throughout
thought
2020
it was best,
until late
and we
2021,
consulted with the
the
regulators,
messaging
and
from the
clearly
Federal
the
Reserve
board,
was that interest rates
was
would
driving
remain
this as
low
the chief
and that
risk
the
officer
inflation that was
reports
starting to
into the
bubble
risk
up
committee
would only be
and
transitory.
it was decided that having our chief
During
risk
this
officer on
time,
board
SVB
as a
invested in
consultant
low
that's
risk,
available
highly
made
rated
the most
government-backed
sense.
securities.
We built out our office
These
of the chief
securities
risk
were safe
officer
assets,
and had those senior
they were
leaders
backed
in
by the
risk
U.S.
management
government
reporting
and
to
could
myself
easily be used
and
as collateral
reporting
for
into
borrowing
the
for
chair
liquidity
of our risk committee.
if we needed it.
So you felt that was better than even just keeping her
These
in
fixed
an
income
interim
securities
position?
complemented our short
We
duration
did.
loan portfolio. Approximately
It's reported that
90% of which
SVB's
had
risk
variable
committee
interest
met
invested
18
nearly
times in
2.3 trillion of their
2022, more than
securities
double the
portfolios
number of meetings
in
in
this low yield
2021.
environment
At any point
created
during
by the
these
Federal
meetings
Reserve.
was the interest rate risk on
To account for
SVB
changing
balance
market
sheet
conditions,
discussed?
namely higher interest rates anticipated over a longer
Congressman,
period of
the,
time.
18
On March
meetings
8th,
were a
we
variety of
sold
different
SVB's
topics. It
available
was
for sale
around
securities
governance
portfolio
and
and planned
controls
capital raise.
and looking at the metrics
Unexpectedly,
around our, it's called a
on
risk
this same
appetite
day,
statement. So it's what
Silvergate
level of
Bank
risk are
announced
you
its
willing to
intent to
accept as an
voluntarily wind
institution?
down and liquidate.
And so the
depositors
liquidity risk
triggered a
would have
run
been the
on
main
that bank.
area where that would have been
Despite
stressed,
stark differences
and
in
that
our
was
business models,
definitely discussed.
news reports
Do you
and
remember
investors
when the
wrongly
first
lumped
time the
SVB and
the
Silvergate
interest rate risk was
together.
brought up?
Rumors
Again,
and misconceptions
my
quickly spread
recollection
online,
was
culminating on
liquidity
March
risk
9th
was
with the
one of the
first
metrics
ever
that was
social
reviewed.
media
And so that would have been
driven bank
discussed
run,
across
leading to
many of the
$42
risk
billion in
committees going
deposits
back
being withdrawn
for a
from
long period of
SVB in
time.
10 hours.
Would you
roughly
say that
$1 million
that was one of the
every
compelling
second.
reasons why you had double the
Over 2
number
days,
of
approximately
meetings in
80% of total
2022
deposits
than
were requested
you
to be
had in
removed from
2021?
SVB.
I
To put
wouldn't
the
say that was
unprecedented
the
velocity of
main
this bank run in
reason, or really
context,
the compelling
the
reason.
previous
It
largest
was
bank
really
run in U.S.
overall
history enhanced
using our risk
$19
management
billion
across the
over
entire
16
platform,
days.
including governance.
In the face of
And
these
so we had
unprecedented
changed the
events,
risk
the
committee
leadership team and I
structure,
made the best decisions we
about a
could
year
with the
earlier.
facts and
And so it was
forecasts
making sure
available
that we
to
had the
us at the
right
time
risk
and in the
governance
best
across
interest
the
of
entire
SVB,
platform.
its employees,
Also want to clear up
and
some
clients.
confusion regarding the Office of Chief
I
Risk
worked at a place
Officer
I truly
Committee and
loved.
the Risk Committee.
Alongside
Were
our
these two
dedicated employees
entities
to
the
support our
same, and
clients
if not, were they
who were
substantially
innovating in
similar in
astonishing
composition
ways.
and function?
I believe that SVB
So the
had a
Office of the
positive
Chief
impact
Risk
on the
Officer
roughly
was actually,
100,000
management level, so it did not include any board members. The risk committee was a board-level committee.
Okay. I see I am quickly running out of time. I won't have time for additional questions, so I'll submit those for the record, and Mr. Chairman, I yield back.
Thank you. The gentleman yields. The gentleman from California, Mr. Vargas, is now recognized.
Thank you very much, Mr. Chairman. I want to thank you again and the ranking member for putting this together. Appreciate it. I actually don't like being in the position that we're in today, failure. I'm a religious liberal. I believe in God's mercy and redemption. And when someone's poor and does something wrong, I believe in redemption for them. And when someone's rich and fails, I believe in redemption for them. So I'm not going to stand here and beat you up. I'm not going to do that. I'm disappointed, obviously, I think, as all of us are, and hope that you cooperate with the government so we can fix some of the problems. And one of the problems that I see is that it seems like the banks, all of your banks, were reactive and not proactive in this situation. And I think you're calling it unprecedented circumstances and events. And I agree with those. I mean, when you move so much money, run on the bank that's so quick and digitalized, it's unforeseeable, not unforeseeable, but again, it's unprecedented. What can we do to begin? I know those on the other side of the aisle usually think of deregulating in a situation like this, and probably most of us on the aisle, and certainly me, I think about regulations, not deregulations. What can we do in this situation, the situations you find yourselves in, for banks not to have this problem? I see that this could affect virtually any bank except for the really big ones. Anytime that social media or short sellers decide to manipulate the stock, they can do that quite quickly through social media, and all of a sudden money can be moved. What can we do? What can the government do to prevent this so people don't lose their money? Who would like to take it? Roffler, why don't you take a shot at it first? Mr. Roffler.
Sure. Congressman, it's a very good question, and one obviously that, reflecting on the last 60 days, I thought about frequently. And sitting here today, it's very hard for me to give any good advice for that because as we learned through March 9th, we were in a strong position. Yes, 2023 was going to be a bit more challenging than 2022 from an earnings standpoint, but when contagion hit after the failures of the two other banks, panic sets in. And so I think my recommendation to others would be,
But is there any trigger, for example, yeah, the panic hits at Wall Street too, so we've put in triggers. We've put in things that slow the system down. Is there anything we could do for that, to slow the system down? Because I think that the banking system is sound. It's resilient, it's sound, but there's always the opportunity for panic. There's always opportunity to make money in panic. I mean, not everyone lost money in this deal. Short sellers made money, you know, and I think we need to investigate them to find out what happened. Is there something that we can do, some trigger, something that the government can put in place so we don't have these runs on the bank?
so I would share that on March 12th, I think they adopted one of the lending programs which banks could utilize, and I think banks did utilize that successfully, so I think that was a good step. But at the end of the day, when the panic sets in, it's really hard to regain confidence. And so absent some evaluation of the insurance on deposits, which I know the FDIC, I think, is requesting comment or offer proposal, I think that's one thing that would be worth looking at because that can at least calm the waters.
Let me ask Mr. Shea that same question. Thank you, sir.
I can't give you a solution, but I can tell you what I believe is a problem that needs to be fixed. And I certainly saw it and felt it that Friday afternoon. It was literally nothing. The customers didn't want to hear anything that I spoke to. They just wanted to get to, I remember, I need to get my money to JP Morgan Chase because the government won't let them go. I need to get my money to Citibank because the government will make sure they save them once, they'll save them again. I mean, it was panicked calls. I need to get my money to a too-big-to-fail bank because they might let you go. I'm not a bank analyst. I don't know banking. I'm just running a plumbing supply area. I'm running a school bus operating business. I'm running a healthcare provider service.
Okay.
Most of them
my
have
time-
deposits well in excess of the insured, and they didn't want to miss payroll. And so there was really very...
My time is up, but I appreciate your answers. But I do think we need to take a look at that because I do think when the panic sets in, there's no way to stop it unless it's insured. Thank you, Mr. Chairman.
The gentleman yields back. The gentleman from Tennessee, Mr. Rose, is now recognized.
Thank you to our chairman and ranking members, and thank you to our witnesses for being here. I know it's not an easy environment, so appreciate you being here to share your insights with us. I want to back up, and if all three of you will hang with me for a second and go back 3 years or so and think about where you were and what decisions you were making in your banks, and then let's imagine that you could have seen forward, that your crystal balls were working particularly well. If you had known, and I'll start with you, Mr. Becker, if you had known that in 2022 inflation would reach a 40-year high, would you have managed the bank differently going into that period?
Congressman, I think about your question a lot in hindsight, and I think that is very hard because I go back and think about the decisions that were made. We didn't have access to that information. Yeah. We only had the information that was available to us at the time.
But let's imagine if you had known that and you could have anticipated the attendant reactions to that, my guess is you would have made different choices. Is that true?
I think if we knew and our team that was making investment decisions would have known that there was going to be the fastest rate rise in 40 years, yes.
And you've anticipated my next question. If you could have foreseen the fastest rate rise in history, you definitely would have managed your balance sheet differently.
I think it's likely we would have managed our balance sheet differently.
And Mr. Shea, same two questions. If you could have foreseen the inflation rate and then the attendant rise in interest rates, you would have made different decisions, right?
Well, I can't say what we would have done hypothetically, but what I can say is that the plan that Signature Bank presented to to open on Monday, March 12th, assumed that we were selling the entire available for sale portfolio, taking any losses that were there, and still were well capitalized after that and met all regulatory definitions. So the Signature Bank portfolio of available for sale was of a controlled interest rate risk, and was not it was not a substantial. It was an issue, but not one that would have caused the bank to even be not well capitalized under regulatory standards.
Mr. Roffler?
Thank you for your question, Mr. Congressman. I have thought about it a lot. And the reality for the last 3 years, and frankly the 37 years in our bank's history, our goal each and every day when we woke up was to serve clients. And that's what we did. We helped people buy homes. We helped nonprofits. We helped small businesses. And we would have continued to do that. And I think the events that unfolded on March 10th were entirely unforeseeable. When contagion and panic spread, it's very hard to control. And so I think that our business model, we were profitable, we were strong, we were well capitalized, and everything changed on the morning of March 10th.
If the Fed had opened the discount window allowing you to borrow against your bond portfolio at par before this all happened, and I'll direct this to you, Mr. Becker, would that have changed do you think we'd be sitting in a different place if that facility had existed in, say, February and following?
Congressman, I actually don't know the answer to that question. I think it would have been hard because of the fact that on Thursday there was $42 billion, and on Friday there was $100 billion requested to be exited SVB. I don't know if that would have helped or not, or would have helped. I don't know if it would have protected against the bank run.
And I'm wondering, Mr. Becker, your bank had an extremely concentrated level of risk or deposits in certain areas. What caused you and your management to believe that those deposits would be sticky if the waters got choppy?
Yeah, as previously mentioned, that's been our model since I recall, working with technology and innovation companies, and our goal at the end of the day was to serve them in a way where that loyalty would be created by being the best place for them to operate, which I believe is exactly what we delivered on. And so that's what we believed to happen. That's what history had taught us. And so we believe that to be the case.
And in the remaining few seconds, I'm wondering if your bank ever turned down deposits as you grew at an extremely fast pace. Was there ever a time when you said, we better not take any more deposits from this customer? Please, if you will, answer that for the record. My time's expired. I go back.
Real quick answer.
Yeah, so the majority of the cash that came in that I talked about with the growth came from existing clients. And so coming from existing clients, we felt that was the right thing to do, was take those deposits.
You can answer the rest for the record. Thank you. The gentleman's time has expired. The gentleman from Illinois, Mr. Kasten, is now recognized.
Thank you, Mr. Chairman, and thank you all for what I know is a long, difficult day here. Mr. Becker, lots of my colleagues have talked about the fact that your chief risk officer was terminated in April 22. I think your written testimony mentions that was under some constructive pressure from regulators. You didn't disclose that you were operating without a risk officer until your proxy statement at the beginning of 2023. Were regulators aware of that decision to delay the announcement to your shareholders that you were operating without a chief risk officer?
Congressman, the decisions around disclosures, we have a process that we would go through. The legal team would drive that.
I'm just asking whether regulators, we have an oversight responsibility with regulators. Were regulators aware of that decision to go 11 months without notification to your shareholders?
I know the regulators were aware of the decisions around the chief risk officer. I don't know if they were aware of any disclosures.
Okay, but presumably it was your opinion that that was not a materially significant fact to disclose for 11 months.
Congressman, that the decision around disclosures is made by, it's a process.
Okay, but you were the CEO. Okay, during that 9 month period, you doubled your number of risk meetings. Did regulators participate in those risk committee meetings?
Congressman,
yes-
the
just a yes or
risk
no.
committees that I was in, I don't recall them participating in any of those meetings. When
Did
they
you
did
did you
participate,
participate in all of those meetings?
I did.
Okay. You mentioned in your opening remarks that March 8th, which was a day that shall live in infamy, you announced the sale of equity to Goldman. You mentioned the Signature Bank collapse. That was also the day that you announced, booked, I think, a $1.8 billion loss on the sale of bonds, also to Goldman. When did you initiate the process of selling equity and debt to Goldman that commenced on March 8th?
To clarify, Congressman, the sale of the securities was to Goldman. The issuing of new shares and securities to raise equity was not to Goldman. They were our investment.
Mediated, but when did you initiate the process with Goldman on both the equity and the debt transactions that culminated on March 8th?
We started those discussions at the last day or two of February.
Okay. And when were you'd mentioned concerns about liquidity risk, interest rate risk. Was that in response to those concerns? And when were those concerns raised that would have caused you to initiate the process to raise equity and sell debt?
Yeah, the process, and again, my recollection towards the end of February, our CFO and I were having a conversation about, if you look at, in the last roughly 2 weeks to 3 weeks, the 10-year Treasury had jumped significantly.
And I'm not looking for the why. I'm just trying to understand the calendar of who knew what when. Because sold March 8th, you're saying you started the process end of February. When were there concerns raised that you needed to start this process? Was that the day before? Was this January?
Congressman, there weren't concerns raised that forced us to do that. We decided to do it and talked about it at the end of February, and we engaged our board, we engaged our regulators, and we talked about it.
And I'm sorry to be cut, but I want to get to it. So you sold 3.6 million of stock personally on February 27th, which would have been right about that time. I understand that process was initiated January 26th. Given all this was going on, did your risk committee sign off on that sale?
The process, and this has been the process for as long as I've been at the bank, is that when you want to sell stock, you put together a 10b5-1 plan. It's reviewed by our legal team.
Okay, but given the timing, you understand my question. Was the risk committee, did they sign off, or was this just they were notified?
I don't think the risk committee would have been notified. It was the legal team that would have concurred with my belief that we didn't have material information.
You've mentioned several times that you don't recall any discussion around interest rate risk prior to 2023. Do you recall concerns that you were overinsured against interest rate volatility?
Can you clarify the question, Congressman?
Well, you've said you don't recall concerns that you had an exposure to interest rate risk, and yet you sold down 97% of your interest rate hedges on your available-to-sell portfolio during 2022. So was there a concern raised that you were overinsured against that risk? Because there was a decision made to essentially take on long-term risk in exchange for a short-term transfer to equity.
As previously mentioned, as far as the decisions around the hedges, 2 points. One is it was against the available for sales portfolio, which is the smallest.
Yes, but it was 97%. You started with 15.3 billion insured, and you ended 2022 with 563 million insured.
The witness can answer the rest of the response for the record in writing, and we will take a brief 5-minute recess to allow our witnesses to take a quick break. I'd ask that they return promptly, and we will return in just a little after the top of the hour. The committee stands in recess.